Hi, this is the RITE Report program, and I'm your host, Chris Engel. I'm the author of 4 books on philosophy, and they're available free for viewing at thephilosophicalangel.com. Along with me is my colleague and co-host, Rick Samuelson. Rick graduated from Yale and has MBAs from Wharton and Tufts, and he's an independent venture capitalist. And good to see you, Rick.
And you.
Approximately once a month, we put out a report on the state of the stock market and the economy. And this is the March report, 2021. And let's get to it. So first what we're going to do is we're going to go over the actual report. And the first thing that we do is we look at the positive and negative snippets that come to us from the various sources of both from the government and from newspapers. So the first thing that we've seen, we're going to go over the negative economic and business data snippets. First is the U.S. Census. Privately owned housing starts is down 6%. The end of month inventories were down 0.6%. Productivity decreased 4.2% in the non-farm business sector. And manufacturing unit labor costs decreased 8.8. That has both the good component and bad components about it. And that's it for negative. Positive on the other side, is quite a bit more plentiful throughout February. The Conference Board Employment Trends Index increased. It's 99.27, up from 98.55. The Consumer Price Index rose 0.3%, and the real average weekly earnings increased 0.8%, as reported by the Bureau of Labor Standards. From the U.S. Census Bureau, business applications were up almost 500,000. It's up 42.6%. From the Conference Board, the previous forecast for global economy improved from a 1.5 average annual growth to 1.7. U.S. Retail and food service sales was an increase of 5.3%. U.S. total business end-of-month inventories was up 0.6%, and sales, U.S. total business sales, were up 0.8%. New orders for manufactured durable goods increased 0.2%. Conference Board measure of CEO confidence stands at 73, up from 64. And advanced U.S. select services total revenue was an increase of 4.3%. And personal consumption related indicators put out by the Chicago Fed National Activity Index increased to 0.66 in January from 0.41 in December. Personal income increased 0.6%, as reported by the Bureau of Economic Analysis, and while consumer spending decreased 0.2%. Sales of new single-family houses is 4.3% up. Real gross domestic product increased at an annual rate of 4.1% in the fourth quarter. New orders for manufactured durable goods increased 3.4%. And the Federal Reserve Bank of Kansas City released its February manufacturing survey, and let's see, and that climbed higher in February compared to a month earlier and a year ago. with an increase of 0.6% in December. World trade exceeds the level of early 2020. This is a very significant piece of information, I think. Because that was just before the advent of the COVID pandemic crisis. The end of month inventories were up 1.3% from last month, as reported by the U.S. Census. Advanced international trade deficits in goods increased 83.7, and that shows an increased desire for overseas goods. The Conference Board extension of lockdowns is expected to be modest at best. GDP growth will be positive at 3.8% in the euro area and 3% in the UK. Personal income increased 10%, while consumer spending increased 2.4% in January, as reported by the Bureau of Economic Analysis. Total construction activity was 1.7% up. U.S. labor unit costs increased 6.0%. In manufacturing, productivity increased 5%, and unit labor costs decreased 8.8%. New orders for manufactured goods in January increased 2.6%. The nation's international trade deficit in goods increased 68.2 billion, and total non-farm payroll employment rose by 379,000 in February, and the unemployment rate was little changed at 6.2%. Positive total snippets were 27, weighing the negative snippets. So if we make a percentage of that, we find that it was 87% positive and 13% negative in the snippets. So now we're going to go to the economic indicator summary. And high yield bonds was down, which means interest rates have gone up or will go up on these high yield bonds. And we're going to discuss a little more on that a little bit later. The iShares Select Dividend ETF, DVY, was positive from 101 to 110. Big jump. Purchasing Managers Index, economy expanding, is at 60.8%. And Purchasing Managers Index from the IHS market is also expanding at 58.6. Construction spending was 1.7% up. Unemployment was positive. Decreased to 6.2%. Civilian force participation rate decreased to 61.4%. It's a negative. The employment population ratio increased to 57.6%. That's positive. And employment trends index increased positive, making it a positive. So all in all, we're going to give that a positive. Productivity decreased 4.2%. Output increased 5.5%. And in manufacturing, productivity increased 5%. Output increased 13%. So we got 3 positive, 1 negative. We're going to give that a positive score. And the quarterly manufacturing report, manufacturing, mining, wholesale trade, and selected industries. After-tax profits were up 100 billion. And the retail sales, advanced estimates of U.S. retail and food services was an increase of 5.3%, and the combined value of distributive trade sales was up 0.8%, and the all-important industrial production index put out by the St. Louis Federal Reserve showed an uptick of industrial output. And the velocity of money, also put out by the Central St. Louis Fed, did uptick also. New residential construction is 10.4% up. The Conference Board leading economic indicators increased in February and in January, and the Conference Board economic indicators also increased. New residential sales was 4.3% up, and advanced report on durable goods, manufacturer shipments, inventories, and others, and orders. New orders was up 3.4%. Existing home sales up 0.6%. Real GDP up 4.1%. Personal consumption expenditures up 2.4%. Personal income up 10%. Restaurant Performance Index 99.1. It's up a little bit from 98.6. Although up, it still has not. The industry itself is not yet expanding, but it's coming back because I think a level of 100 increase that the industry itself is expanding. It's just getting its sea legs back and getting back to order here, to what it once was previously. Corporate profits increased in the third quarter, and manufacturing shipment inventories and orders, new orders increased 2.6%, another positive indicator. And world trade volume, as we discussed up previously, is up with an increase of 0.6%. Chicago Federal Reserve National Index was up 0.41%. 0.66 in January, and the housing price indicator, housing prices rose 11%. 27 positive indicators out of 28 that we use. We've never seen this before. 27 positive economic indicators out of 28. I don't think we've ever seen that here at the RITE Report, which we've been going through, which we've been producing our RITE Report since 2009. So we're going to go over here the domestic political risk. Democrats have captured control of Congress and the executive branch. Their campaign rhetoric indicated a preference for future tax increases. Near-term plans seem to be centered on social justice and fossil fuel. So we're going to give that a -5. The corporate taxes remain in place. Okay, good. +8. Regulations will likely increase. We're going to give that a -3. Government and corporations are spending money on research. Good. +8. Technical analysis of the market indicates the market's going to continue to go up, so we're going to give that a +6. General business and economic snippets, as we saw above, is a +9. Economic indicators also can't be more positive than this, almost. +9, total of 32, and we're which makes our RITE Report Index jump from jumped to 72.9%. So that's pretty good. It's the highest it's been since last May. Whoops, is that incorrect? Nope, that's not correct. Okay, go all the way down. Here it is, 70, up from 72 to 9 from 70 point. Let's see what was the last we got before that. So we have to go all the way back to we have to go all the way back to November to see a high score like that. So our conclusion here at the RITE Report is that in spite of markets suffering a devastating downturn from the epidemic, it is now recovering due to the positive business and economic snippets, along with positive snippets in medicines, treatments, and vaccines for COVID-19. Additionally, the strategy index improved slightly this month due to the 27 positive economic indicators. It seems that the Democrats for now are only attempting to bring social justice to the forefront of their policies. It appears that they will not have the necessary votes in the Senate to change tax policies which will allow stock market to continue to advance. This is remains to be seen, though. There's some discussion on this, and we'll get into that in a second. And the RITE Report continues. So therefore, the RITE Report continues to stay long. So go long. So enough of me. Let's hear what Rick has to say about the future prognostication of the stock market and the economy. What do you think, Rick?
Well, this is kind of a classic recovery. Remember, earnings declined about 40% last year, and so that's a huge amount to make up. And as the economy recovers, it's heading in that direction. By the same token, we caution that tech stocks were overvalued last month, and they've suffered a massive correction. I'm glad I sold out, and a lot of others are as well. And so, there are parts of the market that are so ridiculously overvalued, they're going to remain vulnerable to any exogenous shock or endogenous shock, such as a mild rise in interest rates. And we've seen that play out in the market. Every time interest rates rise even a teeny bit, bang, overpriced stocks get whacked. Tesla is a leading example of that. Tesla's way down from its peak. And that pattern it's logical, that should continue, and it's consistent with a rotation out of the tech sector and into cyclicals, and call it the real economy, and into the beaten down oil shares, beaten down manufacturers, beaten down airlines. There are an awful lot of beaten down stocks. So they have arguably a huge amount of room to run before even getting back to normal valuation levels, or normalized valuation levels that we've seen in the past. And from that perspective, there's a way to make a lot of money in the market if you're smart about the sectors and stocks you choose. So I would caution that while being long makes sense under the current circumstances, if you're in the wrong sectors, you could get hurt quite badly by the volatility associated with the normalizing of interest rates, and the fact that certain companies, and these names are obvious in tech, were so enormously overvalued in the first place. I think the risk-return trade-off of bonds versus equity is going to get more complicated going forward as interest rates normalize. I don't think the government's going to the Fed is not going to allow interest rates to rise above a certain level, but coming off of negative real interest rates, that's still a big change, and so bonds are going to be at the margin more attractive than they've been for quite some time. There's that risk to consider going forward. On the government front, I think all the news forthcoming is going to be negative. There'll be massive intervention, regulatory intervention on many fronts. Not all the bad legislation will get through Congress, but a lot of it will. And so, there are going to be significant headwinds going forward. The enemies of the United States almost invariably view Democratic administrations as dovish, and therefore, the risk of hostilities, whether it's Russia or Iran, we've already seen it with Iran, or China, that will be on the rise. They take advantage of these situations, as they did with Obama, quite successfully. And so that's an exogenous factor that's hard to predict, but it will it'll introduce more volatility to the market. So unlike this time last year, when the opportunity for tripling your money in tech was pretty plain and simple, going forward you're not going to have a tripling. The stock market levels, broadly speaking, are higher than they were this time last year. So you're starting off at a much higher valuation base, and overall PEs are much higher for many companies than they were this time last year. And so those sorts of risks, as they crop up, will inevitably cause volatility, and I think this is going to remain a trading market.
Rick, what do you think about the impact of there'll be some taxes that make increases that make it through Congress probably, and what do you think about that impact on the stock market? First of all, when do you think they'll get around to it, and when do you think it'll impact the stock market?
Well, before I answer that, I would note that states are also increasing taxes. This state, Washington State's planning a 7% capital gains tax to go into effect in January. That's not insignificant. New York State is planning a whole bevy of tax increases, and that's true across the country. So it's not just the federal government; it's blue state governments too that are using the COVID crisis as an excuse for raising taxes. So you're going to get a double whammy. You'll stack. The state stuff's already going through and will be implemented in the coming months. At the federal level, it'll be a battle. But the Democrats have until the first quarter of next year, and then the election cycle really kicks in, to ram through all of their favorite policies, and they've lined them all up. And so the drive to pass tax and other legislation is commencing now, post the COVID relief bill euphoria, so-called euphoria. And so I fully expect they will get some of it through, and it will directly impact the stock market. Whether it's the capital gains tax or some version of the capital gains tax increase, or a corporate tax increase, or some version of that, remains to be seen. There's a lot of negotiation ahead.
So nevertheless, it will impact the stock market. I'm going to make a prediction that they're going to get they're going to start getting their bills through Congress by, I think they're in a big rush to do it, and
yes.
They'll probably get it through this spring for 2022 implementation of a tax increase.
Right.
Given that, when do you think that would hit the stock market? Once 6 months before I've heard that.
Yeah, that would be the norm. Yes. So we may have a very dull summer in the stock market.
Right. Okay. Thank you, Rick, as always, and We'll see everybody next month on the next edition of the RITE Report.
Thank you.